there's actually four different outcomes that can happen with a replacement. Okay, I'm going to talk about each one of them really quickly. There's a cancellation, right? So there's cancellation, meaning there is no cash value. You're just getting them a better rate, and you are stopping the draft, and the policy cancels on its own and sunsets on its own, right? We don't want to completely stop or cancel the policy until ours is in effect. We don't want any gaps in coverage, so we stop draft. That doesn't cancel the policy. That changes it to monthly or quarterly billing to where they have no gaps in their coverage, and then the policy sunsets/cancels on its own. So that is certainly one way. That's one outcome on a replacement situation. Another outcome is cash value. They have cash value. They want the cash. You're able to at least match the coverage and premium they already have. But the benefit is they get cash in their pocket. It's not a loan. It's theirs. They can spend it on what they want. So cash value means policy is ending, but they're cashing it out, right? That is another way to end a policy and replace it. Obviously, any one of these options, like you have to be upgrading them, getting them in a better situation. You never want to get people in a bad, worse situation. That's obviously it's always got to be a move up, win-win. But cash value is one way, RPU is another way. What is RPU? Reduced paid up. It's a column right there in your policy. Reduced paid up is another way, it's another angle to replace a policy. So let's say cash value is $1,200, right? So you could get them a new policy and then $1,200 in cash back. Let's say RPU is $2,500 or $2,400, right? That means you can utilize that RPU to where they don't have to cancel their current coverage. So you can tell them, we're not canceling your coverage. We're turning it into paid up insurance for the rest of your life. And then we're reinvesting this new premium into a modern carrier with updated rates. So what does that do? That can upgrade the amount of premium you can get them without any cost. You can get them a lot more coverage without any cost. And then reinvest the old premium, and for the same amount of monthly premium, you can increase their overall final expense portfolio, right? So it's a reduced amount of paid up insurance that they've already earned because of the premiums they've already paid. So if somebody requests a paid up policy, they owe no more premiums. They're covered for that amount of insurance for the rest of their life. They're covered forever with that. It's whole life, but for a reduced amount. That's what they've earned by paying their premiums. So they owe nothing else. That frees that premium up to go invest in a new modern policy with updated rates, right? So very, very simple stuff. Okay. The last way is paid up term. Okay. This is rare. Paid up term is rare, but there is some situations where you can beat the person's rate, even if they have a 2-year wait policy, right? Or even if all you can get them is a policy with a waiting period. It's very rare, but sometimes you can beat their rate. Now, if there's a 2-year wait in your policy, what's the problem there? Gap in coverage, right? Well, paid up term insurance is another way to do that. Somebody could have you'll see in the policy, it's the same type of chart. Extended term insurance is usually what it's called. If you have an extended term insurance in there, you can see it in the policy. Okay, you're in year 4. Extended term is 800 days, right? Extended term is 800 days. That means that policy, if you convert it into extended term, it'll be in full force with that full coverage amount for 800 days. So that gives them enough time to have your policy go into full effect. So again, you've got a policy that is a 2-year wait. They have full coverage right now. Very rare scenario, but your 2-year wait can beat what's in full force right now for them. If there is extended term, you can say, all right, well, this current policy that's in force, extended term, where as long as it's got extended term for 2 years, then it'll be that full coverage amount guaranteed for 2 years. And then by that time, your 2-year wait policy will be in force. I know that's probably a new one that a lot of y'all haven't heard, but that's more rare, but it is an angle to replace. It can work.